Hello all. I and Gitanjali will be giving a brief description on the unit 4, that is creative accounting. Moving to the meaning of creative is a term used to describe the practice of using accounting techniques and methods to manipulate financial statements and present a more favorable picture of the financial performance. While other creative accounting practices may include legal, others may be considered unethical or even fraudulent. Creative accounting also involves a range of techniques which includes revenue recognition manipulation, expense manipulation, asset valuation manipulation, and liability manipulation. For example, a company may manipulate its revenue recognition by recognizing revenue before it is earned or deferring revenue recognition to a later period. A company may also understate or overstate expenses to increase or decrease net income, overstate the value of assets to increase net income, or understate or overstate liabilities to manipulate financial ratios and to make the company appear more financially stable. The motivations behind creative accounting can vary but often include the desire to meet financial targets, secure funding, avoid regulatory scrutiny, and inflate stock prices. However, engaging in creative accounting can have a negative consequences for the company and its stakeholders. To give an example, it can lead investors and other stakeholders by presenting a distorted picture of the company's financial health. While some creative accounting practices may be technically legal, they can still be considered unethical or even illegal if they involve deliberate deception or fraud. In some cases, creative accounting can result in legal and financial consequences for the company, including regulatory investigation, lawsuits, and loss of investors' confidence. Additionally, executives and auditors may also be held personally liable for engaging or in enabling creative accounting policies. In a summary, creative accounting is a practice that can have a serious implications for companies and their stakeholders, while some practices may be legal but still be unethical or fraud. If they used to deceive investors or their stakeholders, companies that prioritize transparency and ethical accounting practices can build trust with investors and ensure a long-term success. Moving on to the next topic, that is types of creative accounting. Creative accounting refers to the various accounting practices that can be used to manipulate financial statement to make them look better or more favorable. Now here are the types which I'll be explaining in detail. Revenue recognition manipulation. Revenue recognition manipulation is one of the most critical aspects of financial accounting, as it is a key determinant of the company's profitability. Revenue manipulation practices can involve recognizing revenue before it is earned, deferring revenue recognition to a later period, or booking revenue from non-core activities to inflate overall revenue figures. If I have to give you an example, a company may recognize revenue before it is actually being earned, or may recognize revenue from a project that is still in progress. Alternatively, a company may defer revenue recognition until a later period or in order to meet revenue targets for a particular period. Another example of revenue manipulation is booking revenue from non-core activities, such as sale of assets, in order to inflate overall revenue figures. Moving on to the next type, expense manipulation. Expense manipulation involves understating expenses to increase net income or overstating expenses to decrease net income. Companies may also manipulate expenses by capitalizing expenditure that should be expensed, such as research and development costs, which can inflate assets and reduce expenses. For example, a company may delay expenses to the following period or understate expenses by failing to disclose certain assets or liabilities, such as warranties or litigation costs. Alternatively, a company may overstate expenses by recording excessive depreciation expenses, which can decrease reported profit. Moving on to the next type, asset valuation manipulation. Asset valuation manipulation involves overvaluing asset to increase reported profit or undervaluing asset to reduce tax liabilities. For example, companies may inflate the value of intangible assets such as patents or trademarks to increase reported profits. Alternatively, a company may undervalue assets such as inventory, fixed assets to reduce tax liabilities. Moving on to the next type, liability manipulation. Liability manipulation involves understating or overstating liabilities to manipulate financial ratios or to avoid regulatory requirements. For example, company may understate their pension liabilities or lease obligation to make the financial statements appear more favorable. Moving on to the next type, off balance sheet financing. Off balance sheet financing refers to a practice of keeping certain assets or liabilities off the balance sheet to avoid negative impacts on the financial ratio or to hide the debt from investors. For example, a company may use a special purpose entity to hold certain assets or liabilities off the balance sheet. Off the balance sheet financing can be legal or illegal depending on the circumstances. Moving on to the window dressing. Window dressing involves practices such as selling assets at the end of the reporting period to make the company appear more financially stable. Companies may also engage in window dressing by postponing expenses or accelerating revenue recognition to improve financial ratios. For example, a company may delay capital expenditure until after the end of the reporting period or may accelerate revenue recognition by offering discounts to customers who agree to pay early. Moving on to the next, creative interpretation of accounting standards. Accounting standards provide guidelines for financial reporting, but there may be room for interpretation. Companies may engage in creative accounting by interpreting accounting standard in a way that is more advantageous to their financial position. To talk about an example, companies may also interpret accounting standard related to revenue recognition in a way that allows them to recognize revenue earlier than usual. This can be legal or illegal depending on certain circumstances. Moving on to the next type, channel stuffing. Channel stuffing refers to the practice of shipping excess inventory to distributors or retailers at the end of the reporting period to inflate revenue figures. This can create a false impression of the demand for the company's products. Moving on to the next type, capitalization of expense. Companies may capitalize expense that should be expensed, such as research, development cost, and advertising expenses in order to inflate assets and reduce expenses. This can create a false impression to the company's financial health. Moving on to the last type of creative accounting, improper use of reserves. Reserves are funds that are set aside by the company for a specific purpose, as you know well, such as to cover future liabilities, late reported earnings, or to avoid taking written downs on assets. Now, let's take a look at the real examples and frauds that's been happened in the creative accounting. One of the creative examples could be Satyam Computer Services. To talk more about Satyam Computer Services, it's a leading Indian information technology services company. The Satyam scandal is considered one of the most largest accounting scandals in India's corporate history, and it's involved a large range of manipulation that ultimately lead to the company's downfall. Background: Satyam Computers Services was founded in 1987 and quickly became one of the India's leading IT services companies by the mid 2000s. The company had a market capitalization of more than $10 billion and employed more than 50,000 people worldwide. However, in December 2008, the company's chairman Ramalinga Raju admitted to a massive accounting fraud that has been ongoing for several years. The fraud, the Satyam scandal, involved a range of manipulations that were designed to inflate the company's revenue, profits, and cash balances. Some of the key elements of the fraud include Satyam inflated its revenue by booking fictitious sales that never actually occurred. The company created fake invoices and other documents to support these fraudulent transactions. Satyam also inflated its cash balances by depositing money into the company's bank account and then creating a fake bank statement to make it appear as though the balance were higher than they were. The company also inflated its interest income by reporting interest on fictitious deposits. Raju and other senior executives engaged in insider trading by buying and selling Satyam shares based on their knowledge of the fraud. Raju sold a significant portion of his own shares before the scandal became public to avoid significant losses. The impact of Satyam scandal had a significant impact on the company. Its employees and the broader Indian business communities. The company's share prices plummeted and its clients began to abandon it in droves. Satyam employees also suffered many lost their jobs and were able to find new employment due to the stigma of the scandal. The Indian government was forced to intervene to prevent the collapse of the company. Ultimately, Satyam was acquired by Tech Mahindra in 2009. So, what did we learn from Satyam scam? So, it highlights the importance of corporate governance and transparency in accounting practices. The fraud was able to persist for several years because of the lack of oversight and independent auditing. To conclude, Satyam scandal is the stark reminder of the danger of creative accounting and the importance of transparency and good corporate governance. The manipulators carried out by Satyam executives were designed and deceived investors, employees, and other stakeholders, and the impact of devastating. While the scandal was a dark chapter in the India's corporate history, it ultimately led an important reforms that have strengthened the company's and the country's business environment. Moving on to another example of creative accounting is a case of Enron Corporation, which was an American energy company that collapsed in 2001 following revelations of massive accounting fraud. The Enron scandal is considered one of the most significant corporate scandals in US. The history had a far-reaching impact on the business community and accounting profession. Enron was founded in 1985 and grew rapidly to become one of the largest energy companies in the world by the late 1990s. Enron had a market capitalization of over 70 million and was seen as a model of corporate success. However, in 2001, the company's fraud was exposed and it filed for bankruptcy, leading to the loss of thousands of jobs and millions of dollars for investors. The Enron scandal involved a range of accounting manipulations that were designed to deceive investors and inflate the company's financial performance. Some of the key elements of the fraud include off-balance sheet transactions, where a variety of off-balance sheet transactions to hide its debts and inflated profits. Mark-to-market accounting. Moving on to another example of creative accounting is a case of Enron Corporation, which was an American energy company that collapsed in 2001 following revelations of massive accounting fraud. The Enron scandal is considered one of the most significant corporate scandals in US. The history had a far-reaching impact on the business community and accounting profession. Enron was founded in 1985 and grew rapidly to become one of the largest energy companies in the world by the late 1990s. Enron had a market capitalization of over 70 million and was seen as a model of corporate success. However, in 2001, the company's fraud was exposed and it filed for bankruptcy, leading to the loss of thousands of jobs and millions of dollars for investors. The Enron scandal involved a range of accounting manipulations that were designed to deceive investors and inflate the company's financial performance. Some of the key elements of the fraud include off-balance sheet transactions, where a variety of off-balance sheet transactions to hide its debts and inflated profits. Mark-to-market accounting. Enron used mark-to-market accounting to value its energy derivatives, which allowed it to book projected future profits as the current income. This accounting techniques was highly subjective and open to manipulation, and Enron used to inflate its profits. Enron also inflated its revenue by booking sales that never actually occurred, just like we saw in the Satyam scam. The company created false invoices and other documents to support these fraudulent transactions. Enron executives engaged in insider trading by selling their own shares in the company before the scandal became public. The executives were aware of the fraudulent accounting practices and sought to profit from the company's artificially inflated stock price. The Enron scandal had a significant impact on the company, its employees, and the broader business community. The company's stock price plummeted and it ultimately filed for bankruptcy, leading to the loss of thousands of jobs and millions of dollars for investors. The scandal also had a far-reaching impact on the accounting profession, leading to significant changes in the accounting regulation and increased scrutiny of accounting practices. So, what did we learn from this scandal? The Enron scandal highlights the importance of transparency and accountability in corporate accounting practices. The manipulations carried out by Enron executives were designed to deceive investors and inflate the company's financial performance, and the impact was devastating. Following the scandal, the US government introduced new regulations such as Sarbanes-Oxley Act to improve corporate governance and accounting standard. To conclude, uh, the Enron scandal is cautionary tale about the dangers of creative accounting and the importance of transparency and good corporate governance. The manipulation carried out by Enron executives were designed to deceive investors and inflate the company's financial performance, and the impact was devastating. While the scandal had a far reaching impact on the business community and the accounting profession, it also led to important reforms that have strengthened the US regulatory environment. By this, I would like to conclude my presentation. Now, Gitanjali will take over.
Hello everyone. I'll be explaining some of the case studies related to creative accounting and also the legal aspect of creative accounting. The first case study is impact of creative accounting practices on financial statements. This paper presents an initial study considering the impact of creative accounting on financial statements in the companies, and that determines the involvement of the companies, and this study adopted descriptive design of the factor type with a sample of 100 audit and academic perspective. The company misusing cutting edge accounting procedure might lead to financial statements that are deceptive in order to meet management expectations of the company's success. Corruption in today's society and companies worldwide are crumbling. Consequently, accountants must adhere to ethical standards much more stridently than they currently doing it. And also, the company provides to consumers of a company's financial statements. They are the most significant obstacles to stabilizing its true and actual financial performance. This paper aims to investigate the involvement of the Palestine enterprise or the companies in creative accounting and shows how creative accounting impacts the financial performance of the firms. It also helps investors, auditing bodies, and company management by providing them with possibility to see a reversal of these behavior in the financial statement of these companies. The result showed that accountants and academics evaluated the impact of advanced accounting approaches on the reliability of financial reporting to improve its credibility. This research shows that statutory auditors may play a key role in minimizing the detrimental impact of new accounting system on financial report. Moving on to second case study, which is cash flow reporting potential creative accounting techniques. This study shows the cash flow reporting issues and trying to establish if there is an interest in the using creative accounting technology in order to manipulate cash flow reporting. Another issue was in this paper, which focused on the possibility of using hedging opportunities by financial managers of companies in order to at least partially protect their future cash flows from the external fluctuating factors. Cash flow is often considered to be one of the cleaner figures in the financial statements. The most reliable companies benefit from strong cash flow is reflected in its image. A strong cash flow means being more attractive, and in the end, that is what an investor needs. When it comes to cash flow manipulation, we can say without risk of error that all it comes down to embellish the image of the company and to distort the perception of financial statement users. Cash flow being the lifeblood of the companies, its importance is beyond words. That's why if a company can distort this particular area, it has already won a privileged place on the market. Creative cash flow reporting refers to any and all steps used to creative and altered impression of operating cash flow, especially and in the process provide a misleading signal of firm's sustainable cash generating ability. This step employed in order to mislead or mispresent the firm's sustainable cash generating ability. Moving on to next concept, which is legal aspect of creative accounting. Creative accounting is legal in that it exploits loopholes in laws and regulations, but it can ultimately lead to accounting frauds, as was the case in the Enron and World.com scandals. The beginning of creative accounting is a result of the possibility of the rules that exist within the present accounting regulations, which, if were applied without deviation, could lead to a true and fair view of the financial position and of the performance of different entities. Thank you.